Welcome back to another Old Mutual Wealth Coffee Chat with Tiaan Herselman, Head of Advice and Proposition, where today we delve into the detail around living annuities and living annuity drawdowns and the pressure that comes on withdrawing that income. Tiaan, what is a sustainable drawdown rate in your opinion in current market conditions?
Yeah, I think it's not just current market conditions. I think our research is based on historic conditions and also projections into the future. But I think we've always been of the view that a 4% drawdown is what we would consider to be safe. And I put the word safe in inverted commas because it's assuming a client has at least 60 to 70% equity exposure, both locally and offshore. So that's where the 4% rule comes in for us at this point in time.
But let's make it practical out there. 4%, not a lot of annuitants can actually draw on that. What are the types of pressures that are on living annuity drawdowns currently?
100%, Dave. I think the average living annuity drawdown rate in SA has actually come down over the last 12 months. It used to be roughly about 7%. It's now actually dipped to below that. But that being said, most people can't live with a 4% drawdown rate. So some of the strategies we've seen in our research is that if 4%, the after-tax income you get from that living annuity is not enough, one thing you could do is take an escalation holiday. So what that means is that if you're investing because you are invested into growth assets that could be negative over 12 months, if you've seen a negative return over 12 months, if you'd be willing to not take an income escalation in that year, that could add quite significant longevity. The second thing we've seen also, which I think especially in a high interest rate environment, again, where your number one objective is income longevity, we've seen a lot of success, and the research again shows it when combining a living annuity with a life annuity. And the simple explanation of that is if as a client, my income need was 6% of whatever my capital value was. From the living annuity, I've got to draw 6%. But now we know that we feel comfortable at a 4% drawdown rate. If I knew that maybe a joint life annuity for two spouses with a 10-year guarantee and with a 6% escalation could give me a starting income drawdown of 6 to 7%. That means that by putting maybe half the capital in a life annuity, it puts more pressure off the income I've got to draw from the living annuity. So I can now probably take a little bit more risk, invest a bit more aggressively the living annuity capital because I'm getting the guaranteed income from the life annuity. Now again, that's for clients where income longevity is the number one concern. I think something else that we also should take into account, we always talk about living annuities, but if we do holistic financial planning, a lot of clients don't just have living annuity capital, they also have liquid capital, and there's different tax implications in that. That's why we have our financial planning tools like the Wealth Integrator that can show you how you can also manage the drawdown between the two different vehicles to maybe lower your drawdown whilst not sacrificing income longevity or even liquidity.
Tiaan, also, you've delved into the research. You always make it so practical for financial planners out there. Are there some factors within the markets that you can give financial planners to look out for that have an effect on living annuity drawdowns?
I think the one thing that I would also look at is the first couple of years when starting in the living annuity is quite crucial. So we refer to it as the sequence of returns, which basically just means when I start on my journey, is it a smooth ride or is it a bumpy ride with markets? Now, the reason if it's a bumpy ride, why that could actually hurt you is that when your investment value goes down, you don't actually realize the loss until you sell units. But when you're drawing an income, you are physically selling units. So one of the things we've seen that works quite well for living annuity clients is making sure we smooth out the ride in the first couple of years by adding a fund such as the Absolute Smooth Growth portfolio from Old Mutual, which fundamentally ensures that when markets do well, you're not going to get all of those returns. But when markets underperform, such as 2020 or maybe 2008, we take some of those reserves, we put it back into your fund, which means your ride is much more smoother. And that also, in turn, increases the probability of you sustaining that income for 20 or 30 years.
Thanks so much, Tiaan, for those post-retirement tips. And I'm looking forward to what's going to be happening next year with you and your research team. Join us again for another Old Mutual Wealth Debrief Exchange.